You just don't want to own things the government can print because the government's kind of set up to print, and debasement's a necessary event, more or less, on a go-forward basis. I believe that if individuals do not have 25% of their investable assets in what I consider sound money, and the three choices, they will likely experience regret, because I think that we will have inflation, and those three assets are known to protect you from inflation.
We got the two scenarios, either they print or they don't. What would be your controversial prediction for, like, say, the next 5 years?
I think my controversial prediction is that this comes within the next, and when I say this comes, I mean pretty serious monetary event.
What about the plenty of skeptics out there who claim, the system's always been broken? And yeah, sure, it's broken. Of course, it's a fiat system, but it can just keep limping along. Like, what's different this time?
The debt, at a rate higher than you grow the GDP, eventually the gap becomes so large that the GDP can't support the debt. But my belief is it's too little too late. The fundamental problem, Mark, that I don't think most people have really focused on is that just how large this bubble is. And it really got created as a result of ZERP and a lot of free money. The problem is when the cheap money goes away and the money supply stops growing, you're one of two ways out. Either it's all going to or, they're going to.
Larry, you've been warning about the collapse of the financial system for years.
Yeah,
but like most people just don't see it. So
Right.
What would you say is the single biggest sign that we're already past the point of no return?
Yeah, that's a great question. I think it's the debt to GDP level. I think that being at 120% debt to GDP, running large fiscal deficits that even DOGE will not be able to fully fix, and being at a point where it's very likely that they're going to have to ultimately monetize a lot of the debt and the bonds and the interest, we are exhibiting a pattern that other countries in the past have exhibited, and which is to say, the currency is slowly but surely failing. We're in what I would call kind of a sovereign debt crisis, and I think the two market factors that suggest that's correct are, the price of gold is at record highs, had another one today, and Bitcoin is just off a record high. It was at 106. It's come back in, but it'll continue up later this year, I think. So those two things are a warning sign to me that we're getting to kind of quote unquote what I would call the critical stage of monetary debasement and a crack up in our financial system. And there are those who say that you can kick the can down the road and everything's going to be okay. And they've kicked the can many times. They may be able to kick it again, but what the book shows, there's a chart in there by Brian Hirschman that shows that typically when countries get to 130% debt to GDP and they're still running deficits, it's really hard. In fact, it's almost, there are no cases where the country has gotten out of that without having either a big depression or a monetary reset, i.e. high inflation, sometimes hyperinflation, not always, but just high inflation at least. So I think those things are coming, and they appear to be getting more critical. I mean, they've done a good job kicking the can. They had their reverse repo thing that and Janet turned all the bonds into short-term bonds, which were cheaper, but the inflation has not been fully tamed, and in my view, and the numbers are kind of showing that. And so eventually the bond market's going to revolt, in my opinion. So I think we're kind of getting there, Mark. Now, it could be tomorrow. It could be. I'd give myself a 2-year window for it to play out. But interesting today, I thought that the Fed trimmed their quantitative tightening. I mean, that was a signal, right?
Yeah, it's a crack for sure. You mentioned a data point of once a nation has broken 130% debt to GDP. Another data point is that once a nation spends more on its interest than it does on its military.
Right. That's another good one. Yeah, there's a name for that. There's somebody's law. I can't recall who now. But yeah.
Yeah, so it's not just one data point, one indicator. We have multiple indicators that are sort of flashing this red signal.
Yeah, I think that's right.
Yeah. Now, what about the plenty of skeptics out there who claim, the system's always been broken? And yeah, sure, it's broken. Of course, it's a fiat system, but it can just keep limping along. Like, what's different this time?
Well, again, it's the compounding effect of the debt and the interest, and the way you grow the debt, at a rate higher than you grow the GDP, eventually the gap becomes so large that the GDP can't support the debt. So, in Volcker, for example, solved this problem back in the early 80s or 1980 by raising interest rates massively, but he also had a debt to GDP of 30%. We're at 120, 125%. So
right.
I really just think it's kind of numerical. Now, that doesn't mean we can't go to 150%. We could. I mean, I just don't know. But I would suggest that we're getting close to the stage where it's going to be a problem. I think the other thing we could discuss, and I'm sure you're very familiar with it, and James has talked to us about it as well, is just the nature of the kind of the doom loop where, higher interest expense means they have to have a bigger deficit. Bigger deficit means they have to sell more bonds. They're selling bonds into a market of a certain size. You have more to sell, and the size is only a certain size. Interest rates are going to go up, and that higher interest cost then flows back to the federal budget deficit, gets bigger, so you got to sell more bonds, and as you can see, it's what we've called the debt doom loop,
Yeah.
where it's reflexively getting worse. And so, that could change. I mean, if interest rates came down a lot, or if deficits came down a lot, we'd be going in the other direction, and it'd be a different equation. And I know there's some, and I think the market and a lot of people are hoping that this Doge thing is going to solve the problem, and it's a step in the right direction, cutting back on expenses. But my belief is it's too little, too late.
Hey, I want to take a break just real quick to let you know that the Bitcoin conference is coming up May 27th through 29th in Las Vegas. Now, look, it's not just about Bitcoin. This is the largest, most culturally relevant event in the world going on right now. I'll be there speaking, again, for the 4th year in a row with lots of people from entertainment to politics through money and everything else. It's super important to get to these events because this is where you build relationships. This is where you gain knowledge. You can't do that from home. You can't do that watching videos. So come hang out at the Bitcoin conference, May 27th through 29th. Save some money and use my code MarkMoss, or I'll link to it down below. Save some money, and if you use my code, I'm going to do a private meetup. You can come hang out with me and some of my friends there. So check out the code down below, and hopefully I'll see you in Vegas.
Well, wouldn't it be a damned if you do, damned if you don't scenario where if they were to bring the deficit down into check, then we have massive deflation, which is the opposite
Well,
side
that's
of that
right.
coin.
As Luke, Groman so intelligently points out, okay, fine. So you want to spend less money and then you're going to have a recession, and then maybe the stock market's going to come down, and then tax receipts are going to fall, and so one could actually argue that the Doge, even if it works, it won't work because it'll put the economy into a downturn. I mean, the fundamental problem, Mark, that I don't think most people have really focused on is that just how large this bubble is. And it really got created as a result of ZIRP and a lot of free money. And so we had two very big instances of ZIRP. One was after 08, from 08 to 015. And then we had another one that started in 2019 and went until Powell started raising rates in 2022. And so when you have that much free money, low-cost money, financial actors and others take it, borrow it, cheap prices, use it to buy assets, lever up, and it becomes reflexively upward. The problem is when the cheap money goes away and the money supply stops growing, you're one of two ways out. Either it's all going to collapse, a la 1929 when you go into a depression, or in order to prevent, or 2008 when we would have gone into a depression if they hadn't printed money, or they're going to print the money to solve the problem. And historically, looking at the facts and what the Fed has always done, I think that faced with a big downturn, arguable depression, huge unemployment, as they said in 08, the ATM's not working, or printing the money with the risk of inflation, they will always choose print the money versus the alternative. That's certainly been the pattern. It could change. No guarantee that it happens, but it seems likely that that's what they'll do.
I want to talk about those two dates specifically, but let's go back a little bit further back in time.
Sure.
I mean, you wrote the book, The Big Print. I can see it there on your shelf behind you, the orange book. Maybe you have a copy on your desk you can hold up for the camera.
Yeah, I do. Here, I'll hold it up for people.
Which is flying off the bookshelves right there. The Big Print just came out for audiobook, so go ahead and just get that audiobook.
Well, it'll be out in about a week on audio. We're just finishing it up. Yeah.
Probably by the time this video comes out, it'll be ready to go. Okay. But this is really, you mentioned both gold and Bitcoin here. Two different technologies, if you will, but both sort of trying to solve a similar problem, which would be, a life raft from debasement, right?
Correct.
And so, we're partners in the Bitcoin Opportunity Fund, and you've also had a gold fund for a long time. So you've sort of been on both sides of protecting yourself against this debasement for a long time.
Correct.
So I guess, when did you realize that this whole financial system was a scam, was doomed to fail, and you needed to start setting up these life rafts?
Well, 1998 was the first wake-up call when they bailed out LTCM. But and the dot-com, or the house, the dot-com bubble, I knew they were printing a lot of money to allow that to occur and keeping rates too low. But so then a little bit, and then it got worse during the housing bubble in 2003. When the dot-com bubble burst, and Greenspan's reaction was, let's take rates from 6% down to 1%, and he suggested everyone take out a home equity line of credit. They blew a housing bubble to cover up for the dot-com bubble bursting. And I guess what really radicalized me, Mark, it made me and at the time I was managing a gold fund, and of course pre-2008 there was no Bitcoin, so it wasn't even a choice. But when 2008 came and they went to QE and ZIRP and very aggressively printed money, bailed out the banks, etc., that was a huge wake-up call for me. And at that point I became very, very much radicalized for sound money. Prior to that, my investing career was investing in technology and technology businesses, and which had done pretty well. There's a lot of technology companies that grew from 1980 to 2003 or so. But when 08 came around, they started printing money, and at that point in time, I said, "All right, this is totally different. There's debasement in our future." I thought it was going to happen much more rapidly than it happened. We can get into the kind of details of that, but basically, I pivoted. And that's when I started running the gold fund, where I was focused exclusively on gold and silver mining companies, because I wasn't aware in '08. I wasn't aware of Bitcoin. Very few people were. I became aware of it soon thereafter and bought some in 2013. But so that was really the event. And the interesting thing about that event that I think a lot of people don't always focus on is, okay, so the '08's a crisis, and you can argue you got to do funny things in a crisis to keep things going. I get it. But they took it to ZIRP, in '08, and a couple of years later, things, they weren't booming, but they were stable. And one would have thought they might normalize and go back to, where they were before, but they didn't. They kept interest rates at zero from 2008 to 2015, 7 years. And in fact, as you know, we had negative interest rates in Europe, and there were $18 trillion of negative yielding bonds. You had to pay people to take your money, which is insane. So, it was really a big distortion. And
isn't that because during that period they were just faced with so much deflation, which the Fed, the central banks, cannot have deflation, and so
I think that's right.
They weren't trying to stimulate the economy. I guess you could say they were, but more really what they were trying to do is get some inflation back, and there was just nothing they could almost do. And that might have been probably a combination of technological gains as well as efficiency gains from that, but as well as the globalization as well.
No, I think that's right. they weren't seeing the growth, and things were punk, and they were afraid. They were terrified of if they made money any tighter, they might go back into a deflationary downturn. I think that's correct.
But I think that's an important thing to pick out. And the reason why I want to go back in time, Larry, because you've got the gray hair, you're at the battle scars to prove it, and so you've been paying attention to this for a long time. And if you look back to previous market crashes, if you want to go back to the '70s and see what happened there, in the '90s, the 2000 dot-com bubble, et cetera, I feel that 2008 everything changed. And I think the way that I look at it, and I don't have quite the experience that you do, although I've been through a few.
You were around. You were
doing
stuff.
A few butt kickings, if I might say. But what I'd say
I remember
is
you
that
told me what happened. Yeah.
I think there's so many analysts today that want to talk about the 40s and the 70s and da da da. But I feel like everything sort of changed in 2008, and if you don't understand that, it doesn't really help you see the future. And so what changed in 2008? Well, you tell me, what do you think changed in 2008? And why is 2008, it's almost like a AD, BC kind of a thing. Why is it different now after 2008?
Yeah, well, the Fed just took steps that they had never taken before at a scale that they had never taken before.
Right.
And it became very clear that they just were going to do everything possible to prevent any form of natural deflation or correction. Look, the Depression was a bad thing based on the credit bubble that had been built up into 1929. And, Bernanke wrote his thesis on how he never wanted to have another Depression, and therefore, no matter what it would take, he was going to choose inflation and monetary debasement over a natural correction. And as von Mises has said, when you have a credit bubble and it bursts, the correct thing to do is to just take the pain and reset at some new level, lower, and there's a downturn. But the Fed decided, no, we're not going to do that. We're not going to liquidate all these bad investments, this malinvestment. We're going to try and prop them up with free money. And you're right, that's when it changed. I mark '08 as the period where the kind of the fourth turning really got going. And I think this fourth turning is all about, what is money and how is the monetary system going to operate. And again, that kind of goes back to why I wrote the book. I mean, I was watching a debate last year with, Team Blue and Team Red yelling at each other, and I felt enormous frustration because I thought to myself, these guys aren't focusing on the underlying problem. The underlying problem is the money's broken. And,
so would you say,
and that's what we're all here to try and fix, right?
So would you say then, like, previous crashes, the 70s, the 90s, 2000s, they were sort of letting the pain sort of set in. They're letting the deleveraging sort of happen. But in 2008, they just realized that it's too big. It can't do that. We're not going to accept it. And so it was really a fundamental shift of the psychology of what they're willing to take.
I think that's absolutely right. I mean, look at the S&L crisis was in 1990, 1991. Excuse me. In 1990, 1991, and they've liquidated all the S&Ls, and they've sent guys to jail, and
right.
It was a big credit bubble, and they just let it self-correct, and that was how it should be done. In 98, they kind of did a quasi bailout because LTCM blew up, and all the New York banks would have been bankrupt, but they got together and provided swap lines to them, and all they all participated. But that was kind of the precursor, and the book talks about this, how 2008 was something the banks could push it as hard as they did in 2008 because they remembered 1998, and so they knew that if they got too far over their skis, the Fed would come save them like they did in 98.
Yeah,
but each one's gotten bigger, right?
Yeah. And what it looked like to me was in 2008, they also were going to let it run its course. So we saw in 2006, housing, which is a really good bellwether for the economy, housing starts were down 28% in 2006, right? But we didn't see any bailouts starting until 30 months later, something like that. Even when Bear Stearns collapsed, which is, sort of known to be the trigger of this whole collapse, it took 7 months to gain it.
Right.
So it's almost like they were letting it, and then it just got too carried away. Okay, this is it. They went in with the big bazookas, and now it's so levered up, they can't even let it deleverage a little bit, not even a 2008 level.
I think that's extremely accurate. That's right. I mean, basically there's a level at which they will not let the stock market go down below or the interest rates go up above. I mean, and we saw that in March of 2020 with the COVID example. The stock market falls, everything's no bid, all the leverage is unwinding, and boom, Powell comes in with a total bazooka, and they print $5 trillion in an 18-month period. On the flip side of that, even more recently in September of 2023, the 10-year yield went above 5%, which I think is kind of the red line. They just feel like we can't have interest rates above 5%, or else the leverage will eat itself up or cause a collapse. And so, within 3 weeks, you saw 12 Fed governors come out and say, well, we're done raising rates. And of course, the 10-year calmed down and went back down into the low fours. So they're it's very much on a hair trigger, and it's a very leveraged system. And that's why, although Powell pretends that he's got it all under control and that everything's going to be fine, and that we're going to recover and come out of this whole thing, my guess is he's just counting the days until he can get out of there in March of next year, when his term is over. Because the third Fed mandate, and I talk about this in the book too, is to keep the financial system operating. When things break.
That's probably the most important mandate.
Right, exactly.
Yeah.
I mean, mandate 1 and 2 is inflation and full employment. I get that, but the real thing is, we got to have if things start collapsing, if this big levered tower that we built starts to fall down, they got to come in with the money. And of course, that's why the Fed was originally established, because the bankers back in 1907 came close to blowing up, and J.P. Morgan saved them. But they said, we're not going to let that happen again. Let's get the government to backstop us. And therefore they created the Fed. So yeah, and it's, I think the reason you asked earlier, how do we know it's happening? Now, we don't know exactly, but we can see that the size of the interventions is getting larger, and the timing is getting quicker. I mean, Bernanke, as an example, took the Fed balance sheet from $900 billion to $3 trillion over about 3 years, roughly. Powell took it from 4, somewhere 3.7, just below 4, to 9 in 18 months. I mean, it was like, bang, $5 trillion. Let's just do it.
Yeah.
It's a lot of money.
Yeah.
Yeah, go ahead.
I was going to say, yeah, and as I mentioned, from the time Bear Stearns collapsed, it took 7 months to get a bailout. But in 2023, when we see 3 banks collapse, they had a bailout in 6 days.
Exactly, exactly, and that. They're very much they're very much aware of the fragile nature of the system, and they have one tool, which is a printer, and they will use it, which is the name of the book, right? The big print, because we've had two big prints. We had one in 2020, we had another in 2008, and we had a little one before that in 1998. But I think that each one is going to kind of get bigger, and each one chips away at the foundation of trust in the government and in the Fed and in currency. And so, anyone who saves capital has a choice of places to put it. They can put it in bonds, they can put it in stocks, they can put it in gold, they can put it in Bitcoin. And to me, big market indicator that trust is rapidly, slipping is, Bitcoin at 106, it was, come back there soon, and gold at 30, it's like 30.50 now, which is stunning to me, actually. I knew gold was going up, but it's gone up faster than I even anticipated. And I think that's just because more and more people are coming to the realization that you have and that I have, that is, the system is broken, and there's not an easy way out. There's not an easy way back. And we're going to have to return to some kind of a sound money system here at some point.
Yeah. A lot of people are maybe caught off guard looking for a big event to come. They've been told over and over and over, the dollar's going to die, the end of the dollar's coming, blah, blah, blah. Yeah. I remember a few months ago, I had a buddy call me up. I forget what the news trigger was, but he saw something on the news, and he texted me, Mark, I need to talk to you. Is this all going to collapse? I'm going to wake up tomorrow, and my money's going to buy half as much, stuff. Yeah. And I said, it already has. Like, in the last 5 years, you can buy half as much house, half as much gas, half as much, right? So it's like, everyone's waiting for this big event to come that they're going to lose half of their money, but I was like, you already did just lose half of your money. So maybe they don't understand that. Is that, I know you wrote the book, The Big Print, sort of as a public service announcement. You said you sort of wanted mainstream to kind of understand what's going on. What is that the message? What is the message you're trying to get through?
Yeah, well, the message I'm trying to get through, the book's divided into two parts. The first part is why the monetary system runs the way it does and how it's broken. And I try and point out how unfair it is that certain people can borrow very cheaply and other people have to pay 25% for credit card interest rates. And so I try to point out that the system has been constructed to benefit people who know how to game it and actually benefit from inflation, and I want to get the average citizen angry with the fact that they're being silently robbed through this, inflation. And they know it, and that's why there's so much political dysfunction. They know it because they go to the supermarket and things are costly or much more costly, and yet their wages aren't going up. And so they're getting squeezed. And of course that makes them angry. And so Team Red blames Team Blue and Team Blue blames Team Red. But neither one of them is looking at the Fed and blaming the real source of it. Money supply, as you know, it went up 40% in 2 years in the COVID pandemic. And that was basically like saying to anybody who had worked for 20, 30 years, had some savings, we're just going to cut the value of savings by 40%.
Right.
Yeah, it's terrible. And so I want to first explain that to people so that they don't fall for the politicians who are saying, well, it's the greedy corporations. No, it's not. It's the Federal Reserve. And then once I explain that, of course, they'll maybe be angry. And maybe, that's a depressing message. I hate to deliver bad news, but it is what it is. But then I want to deliver the good news, which is there are ways to protect oneself from that. In fact, there are even ways to benefit from that. And of course, that leads you to gold and Bitcoin, more particularly Bitcoin, because it's more asymmetric than gold, and it really, on a Bitcoin standard, people who've been living on a Bitcoin standard have been saving all their money in Bitcoin. There's a great a metric in the book that just shows the price of a house in Bitcoin, and even though the nominal price of a house has gone up over the past 10 years, the number of Bitcoin it takes to buy a house has gone down substantially.
Yeah,
and so.
Or said it in another way, not nominal, but the U.S. dollar value of the house went up.
Well, that's correct.
But the Bitcoin price went down.
Yeah, it's all because the dollar's getting to be worth less and less per unit, obviously.
Right. I think if people just understood that everything is a trade.
Right.
Everything's a trade. So I could trade a house for labor. I could trade a house for oil or gold or oranges or rice or Bitcoin or dollars or yen or whatever. And when you start, so then you start to go, well, how much is it in oil or gold or rice? And not just U.S. dollars. You start to kind of see this a little bit more clearly that way. But I think sort of what you laid out, as you said, sort of the bad news is like, here's how the system works and sucks. Hopefully you're angry, but it is what it is. It also sort of shows like the inevitability of what's coming, right?
I think so. I mean, look, I try to game theory out how I could be wrong, and I've been wrong somewhat. I mean, I thought in 2008 that was the big one, and we were going to go to serious inflation, and I was wrong. They changed the rules. They started paying excess money on excess reserves. The banks held the money back, and we got an asset bubble, not really a consumer inflation bubble. But and I've often said to people looking at investing in any of the funds I'm involved with, the one thing that could make this thesis of monetary debasement not be true is if the government balanced its budget and, got serious about, allowing money to be fairly priced.
The odds of that are zero. So
right, exactly. I mean, thank you for saying that. I mean, to balance the budget, they would have to more or less cut the big categories by 50%. And boy, think about that politically. We're going to cut Medicare and Social Security by 50%. I mean, that's not going to get through. And defense, same story. Interest rates, I mean, those are hard to cut, unless the Fed drops rates because the market determines them in many, many senses. So, yeah, it's sadly, it's Keynes counseled. I mean, Keynes was, in my view, kind of a false prophet, and he counseled that, don't worry about doing these things to stimulate demand and get the economy healthy today, and the effect in the long run may not be good, but in the long run, we're all dead. Well, okay, fine, he is, but here we are, and the long run has kind of arrived, and then you glance at history, and you see that in history, when countries get to this condition where they have this much debt to GDP, it generally doesn't end up well. I mean, there's got to be some kind of a reset, and it doesn't necessarily have to be a bad scenario. I mean, it could be if we had enlightened politicians, we could do a structured reset. I mean, Roosevelt did a reset. He grabbed the gold, which I thought was bad, but he also devalued gold, which made 1934 the best year of the Depression in terms of economic performance. And the problem is pretty simple, Mark, as you know. We just got too much debt. We've used too much debt unproductively, and it's sitting out there weighing on us. And we've got to get debt and GDP more in balance, and the only way to do that is either write off the debt or let the debt collapse, which is very deflationary, somewhat of a depression, or to inflate the money and let GDP grow in nominal terms a lot, so that without growing debt at the same amount, so that the balance between debt and GDP is much more manageable. Right?
Yeah,
and those are your two choices. And a good policymaker, we could figure this out. It would be painful one time, but then we'd be back on a sound money standard. It'd be good. But sadly, and in a prior podcast today, I was talking to somebody, and he said, "Yeah, but Larry, as you know, what are the odds that we're going to have an enlightened policymaker who's going to figure that out?" And I said, "Well, you've got a good point. The average politician doesn't really respond to something until it's a crisis.
Well, the problem is with obviously I think the Constitution, the American way, is the best government we've ever seen, but at the same time, there's deficiencies like having a 4-year window, for example, right? So
correct.
Everyone sees way too short term to go through that pain to
right.
not being in power to see the benefits, the shade of that tree that they planted, right, kind of a thing. So
yeah.
I think what you lay out, the way I look at it is like there's not a way to fix it. This is what happens when you're on a fiat money system. Mm-hmm. So that's the inevitability I was talking about. The dilemma of either continue printing or let it crash is the reality of that fiat money system. So I think then you have sort of a couple things. Like, number one, do they let it crash or do they let it inflate? The way I look at it is most people would much rather see their retirement accounts and their house and all their assets go up, even if the cost of gas and food goes up, opposed to seeing their retirement accounts and housing crash down if it meant gas was a little bit cheaper. So I think everyone would take the inflation, number one. So I think that, and the Fed has sort of proven that.
Yeah, people like rising numbers, even. Yeah.
So I think so my base case is they continue printing. Then the next question becomes, is it some inevitable event where like the point of no return it all falls apart, or is it the law of diminishing returns where each new dollar of debt gets us less growth than the one before it? And if, we used to get 50 cents of debt to get $1 growth. Today we get $1 debt to get 40 cents of growth. And eventually we get 20 cents.
I think it's even less. Yeah, I mean,
or less. Yeah.
Yeah.
And then
I think that's what's going on. I mean, the debt just it's not working, and the the currency will fail, and that's what we're kind of, and you've discussed it many times. You're very, good on it. Is the whole Gresham's law issue? The currency will fail when people realize when a large body of the people using the currency say, you know what, they can just never stop printing, and so maybe we'll transact in dollars because everyone accepts the dollar, but boy, nobody's going to save in dollars. The bond market's going to go away because everyone's going to know that the bond market is a sucker's play.
Yeah.
And in turn, the investments that are sounder, Bitcoin and gold, are going to just soar in value vis-a-vis the dollar.
Right.
And we're kind of seeing the early days of that. And I think that's going to continue and get more intense, unless they reverse the government spending,
So I want to break this down into two sort of buckets. We sort of have like the retail and then the institutional sovereign side. So from the retail side, I mean, wouldn't you think that most people already understand they're not supposed to save in dollars? I mean, like they've been taught,
so.
get a good job,
I think
save for
so.
retirement.
Yeah. I mean, I think so. I mean, I think the average American, is probably saving in real estate, right? They're saving in their house. That's their biggest asset, and they realize the government can't print houses. And so so it's going to go up with inflation, the cost of replacing it, et cetera. The negative there, as I point out in the book, and as you're very aware of too, is just the state has a first claim because it can charge property taxes.
Right.
And you can't move the house, and so you got to pay tax on the house. If you don't pay the tax, they take it away. So So it's not as pure an investment as a neutral currency that cannot be printed. And there are really only two choices there: gold, well, three if you count silver, but the two large choices, gold and Bitcoin. And government can't print them, and so. What the market is telling us is that more and more people are reaching the conclusion that the government is trapped. And you're starting to hear this from really mainstream people, even fiat people who are on the other side. They all say, even Jay Powell said it. I mean, I never had this on my bingo card. Jay Powell says our fiscal path is unsustainable. I'm like, okay, guy, that's great. I agree. You're right. So why are you enabling it?
Yeah. So we have that on the retail side. So most people know that they should be saving, so they're buying their house. They have their paycheck being deducted going into their 401ks or whatever. And
Right.
then we have the more sovereign, institutional side. And I think we've, to the point you made earlier about, we have to sell treasuries into a, not unlimited market. But we have seen a pretty big shakeup, in that sort of store value, sort of the gold market, if you will. Most recently, with you mentioned earlier, gold jumping to 3,000, but really a big shakeup in like where the gold is even being stored, like how it's being moved from the BOE and LBMA over to the U.S. Do you think that shows, what China's doing with their Shanghai Gold Exchange and what those are doing, that there is something even bigger being known and sort of being maneuvered in behind the scenes?
I really do. I mean, I think the clues in the gold market are substantial. As you know, the country lived on a petrodollar standard, and 5 years ago, 10 years ago, 95% of the oil was traded on a dollar standard. But when we grabbed the Russian assets, that changed, and now I understand that the dollar only accounts for maybe 60% of oil sales, and the balance is in other currencies because people don't trust the dollar. And those other currencies, if they have an excess with the supplier, whatever, they're converting that excess into gold. And so you do see the Shanghai Gold Exchange volumes going up quite a bit. You see a lot of gold being imported into China. You see a lot of central banks buying gold. You see a lot of people asking for their gold back and for, what I call repatriation. You've seen it in the United States even, where there have been large shipments out of London and Switzerland to the United States in physical, which suggests that there are people, whether they be, and some people have argued that it's the U.S. government. That's possible. I kind of doubt it. But, there's certainly probably billionaires in the United States who are thinking to themselves, gosh, I don't trust this currency as much. And, holding GLD, which is a gold ETF that, has claims on gold, so it's kind of paper gold. They're saying, you know what, maybe you just give me the ounces.
Yeah.
And those of us who are in the gold market know that for many, many years, they created more paper claims than they had underlying ounces of gold. And so, we're starting to see tightness. So these are all, they're clues. They're kind of smoke, coming out of the windows or out of the side that indicate that maybe there's a real fire. And of course, you want to see a mass exodus towards Gresham's law. If Trump goes and he audits Fort Knox and the gold's not there, now my guess is for national security reasons, if it's not there, they'll lie about it. They have to. But the point I'm trying to make is that there is a bid for gold, and people are losing trust and faith in the government. And so I think that bid's going to continue.
Yeah. I made a video talking about that potential audit of the Fed of Fort Knox. First of all, there's conflicting information that they say no, they do audit it every year, but we haven't seen that publicly.
They
But
don't.
I think the flip side is, what if they found more gold? Then not less. What if they had
Yeah,
more?
there are those that argue that we've grabbed gold. I mean, I know we took the gold out of Iraq, and I think we took the gold out of Libya. There are pictures of soldiers with, bringing it out. So, yeah,
But then
it's
that's
possible.
also equally bad, because then that shows, well, why is the U.S. stockpiling more gold? They don't have their own confidence in their own currency. So it's like almost damned if you do, damned if you don't, so to
Yeah, a
speak.
a little bit.
And I think we
little
saw
bit.
in the futures market with that backwardation, which meant people were willing to pay more for gold today than gold for future,
Correct.
gold in the future. So
All these things indicate there's a tightness in the gold market. There's just no doubt about it. I mean, gold is not behaving the way it has in the past. I mean, it's in a relatively brief period of time, gone up from, 2,000 to 3,000. That's quite a big move, and that's in less than a year. It's actually just about a year's time, because it was about 2070 in early last year, and now it's, 3,000 plus. So it's a 33% move in a year. That's one of the best years in gold of all the years ever. I mean, I don't think there have been many years bigger than that.
well, it responded to
So-
that 40% increase in the money supply. Balance
Yeah,
sheet.
well, that's a part of it for sure. I mean, that's a part of it. I mean, to me, it's a signal. It's telling us something, not to be ignored.
Yeah. So in your book, The Big Print, you lay out a playbook for like surviving this whole financial mess.
Yeah.
What's one
Yeah,
step that everyone should be thinking about taking
Well,
tomorrow?
Yeah, great. So I mean, as you and I both know, when we work on the fund and advise our clients, I mean, the first thing I say is you just don't want to own things the government can print, because the
Right.
government's kind of set up to print, and debasement's a necessary event, more or less, on a go-forward basis. And so, that means that, that takes away bonds, and it takes away just cash and so forth. So you want to be in things the government can't print. And real estate obviously qualifies. As I said earlier, you get the tax issue. I believe, and I say it in the book, and it's not investment advice, it's not investment advice here, but I make a statement that says that I believe that if individuals do not have, 25% of their investable assets in what I consider sound money, and the two choices are gold three choices, gold, silver, and Bitcoin, they will likely experience regret, because I think that we will have inflation, and those three assets are known to protect you from inflation. And I'm not saying you got to put all your money there. I'm just saying that if you don't have anything there, and I know a lot of people who have a ton of stocks and some bonds and no gold, no Bitcoin. And I just don't think that's the right balance of, risk and reward in an environment that's likely to be inflationary. A lot of people have that balance, Mark, as you know, because we did have a big deflationary period from 80 to, 2020.
Yeah.
And technology is deflationary. So, as Jeff points out, I mean, we've got this conflicting system where the technology is creating deflation, but the monetary system requires inflation, and it's at the meeting of those two that the problem has occurred, right? It's tricky, and it's going to be volatile, so I suggest people understand what they own, and try to understand that everything they buy could go up or down, but that you don't want to get rid of the forms of money that can't be printed, because the odds are very high, in my view, that the government resolution of this will involve printing money.
Yeah.
And so they can't print Bitcoin. There are 21 million of them. They can't print gold. It's growing, the supply, but only at 1.7% a year.
I want to take a break real quick and just say that there's only so much you can learn through videos. Yeah, build your knowledge, build your skills, but you need to build your relationships. Relationships plus skills equals money. So come build your relationships and your knowledge at the Bitcoin Conference, May 27th through 29th in Las Vegas. I'm going to be there speaking for the 4th year in a row, and lots of other people way bigger than me. Entertainment, politics, media, finance, you name it, they'll be there. So come check it out. Save some money with my code Mark Moss, or I'll put a link down below. If you use my code to save some money, I'm going to do a private meetup just for you and some of my friends. So let me know. Use that code, save some money, send me a message, and we'll get you in the private meetup, and I hope to see you in Las Vegas.
So, I mean, we got the two scenarios. Either they print or they don't. We've talked about the inevitability of that. I think the timing is obviously the big thing in question. I know you disagree with a lot of people online. I'm curious what your bold predictions are. If we'd talk about the collapse, how does this all play out? And maybe what would be your controversial prediction for, say, the next 5 years?
Yeah, so I think my controversial prediction is that this comes within the next 18 months to 2 years.
Wow.
And when I say this comes, I mean a pretty serious monetary event. I think the stock market is going to roll over. I think it's very overvalued. I think that when that starts to happen, tax receipts will go down, unemployment will go up, people will start screaming. The Fed will be forced into cutting interest rates, and we will see an environment, inflation will not necessarily come down, even though there'll be less demand. There will be inflation in certain pockets and areas. I mean, you look at the union, the longshoremen's union just got a 10-year 60% price bump, or, so there are a 6-year 60% price bump. So it's 10% a year. So inflation, once history shows inflation once started, it's hard to reverse it. So I think we're gonna see more inflation. And my view is that then what will happen is the bond market will start to revolt, and they'll realize they're the sucker at the table. And in light of that, they will start to sell bonds, and so interest rates will go up. So the three things I look at on an everyday basis are the 10-year interest rate, the price of gold, and the price of Bitcoin. And I think when we see the interest rates going up, when we see the price of gold going up, when we see the price of Bitcoin going up, all of those things will indicate that, quote unquote, the money is in the advanced stages of failing. And by the way, the stock market might go up. I mean, it's such a thing as a crack up boom where, at least the stock does. In hyperinflationary economies, stock markets have gone up, and they do that because the stocks represent a claim on a business. But the purest play for monetary debasement are these forms of money that can't be printed. And I think that it'll come to a head where the Fed will then be forced to say, well, we can't pay 6% interest rates on $36 trillion worth of debt. That would truly bankrupt the government. So we're going to need to buy the debt. And so that means back to QE and maybe dropping short-term rates down, and then funding a lot of the debt short-term, so that instead of paying, for the 3.5 they're paying now, that goes back down to 2 or something. And as a result of all of that, we get into a situation where, that the Fed buying that, they buy that with newly printed money. The Fed balance sheet gets a lot larger. Fed balance sheet right now is in the 7 trillion range. The bond market's 36 trillion, U.S. Treasury bond market. So if the U.S. Treasury bond market suddenly all revolted and said, you know what, we're not holding this. We know you guys are going to debase us. We're going to sell it all to you, Fed. Well, the Fed would have to conjure up $36 trillion and add that to the 7 that's already on their balance sheet. Well, that 36, the money supply isn't that large. That would more than double the existing M2 money supply. So, which would be massively inflationary and just compound the problem. And then you get into the whole Gresham's Law event where, everybody realizes, oh my God, this money is buying less and less every day, and gold is going up every day, and Bitcoin is going up every day. If I want to protect myself, I got to buy some of those, or real estate or real things. I mean, it's a crack up boom based on, in the Weimar example, people were buying anything they could buy. They'd get paid and they'd immediately buy something because they knew it was going to cost more in the future.
Yeah,
that's Gresham's Law, right?
Yeah,
So,
the crack up boom.
I think we've got a decent chance. And I know a lot of people argue with me online, say I'm a doomer, and I've been wrong, and I have been. I thought it would happen faster than it's happened, but I believe this could happen within the next few years. I think the problem, the bubble is quite large. I've watched a lot of these bubbles, and the notion that Trump can kind of let the air out of the bubble slowly and manage his way through that, that's, in my experience, that's not how bubbles work. Once they get pricked, everybody sees the pattern and says, "Oh, let me out." I mean, when the dot-com stocks burst, even a good company like Cisco, which was a great company making all the routers for the internet, it fell 80% in value.
And it's never come back.
Right. And so, I think that once people realize that the Mag 7, and the economy is slowing down, the Mag 7 is not as magnificent as everyone thinks, the rush for the exits is going to get, crowded. And, then we'll have the downturn and it becomes reflexive. I mean, in the same way that leverage makes businesses and economies do well on the upside, ask anybody who's got too much debt. When you've got too much debt and your income doesn't go up, you're in trouble. And, things have to get sold quickly on the downside, right? That's how it works.
Just to be clear here, though, if I'm hearing this correctly, what you think in the next 18 to 24 months is your controversial take that the markets roll over, the bond market revolts, which is a deflationary pulse that forces the Fed to do the big print. And then we see a massive, so sort of like a 2020 on steroids, of a quick V dip, so a quick crash into a massive inflationary.
I think that's right. I think that's right. And the economy keeps running. I mean, one could actually argue that the Fed, in trying to fight inflation, was kind of doing the wrong thing. I mean, Luke Gromen has actually made the argument that we should just let inflation run hot for a bunch of years until we get debt to GDP at the right place.
Yeah.
And I'm not entirely sympathetic to that argument, but I mean, the problem really is too much debt, not enough GDP, and so the reset's needed.
I see and I agree with your viewpoint because I believe it's inevitable. I think, in my opinion, I'm more optimistic, so I'd say it's probably a lot further out. I think there's a chance. Inflation is the only way. That's the nature of the system. So it's like not about what we feel. That's what this system is. It's an inflationary debt-based system.
Yeah,
so
no,
it's
this is mathematically assured, right?
Yeah.
Almost.
It's just the severity and the speed.
Totally agree. And I've been wrong a lot. I could be wrong again.
Yeah.
I don't know.
I was just going to say I'm a little bit hopeful. Because what the Trump and Elon, if you will, kind of administration is doing. Doge, one thing, cut expenses, but more specifically, what I'm focused on is taking all the red tape off of the economy. We just saw like 27 EPA regulations get pulled back. 27.
Right.
And so, like, I think that we're about to see a massive repeal. I mean, they've said as much, and per Trump's first term, I believe he'll do it. A massive repeal to all kinds of regulations that are hamstringing. And I think if we could unleash the American economy and maybe, create a little bit more inflation, like ease monetary conditions and unleash the economy at the same time, it doesn't fix the system. The system is inherently bad.
No, I mean, there's a scenario that says you could just have an inflationary growth.
Right. And we just muddle along. You know?
And I'm very open to that scenario being the one that occurs.
But it doesn't change the fact that home prices and gas prices and all other aspects will continue to outpace your income.
There is no stop inflation scenario from what I can see, and I think you would agree with that, right?
And the reason why I wanted to just throw that out there is because whether it's extreme like you see or maybe more drawn out like I see, it doesn't change what's happening. And what's happening is asset prices are going to exceed your rate of income.
That's exactly right.
And you have to take protection either way.
That's exactly right. Well, and yes, and we will have to have some inflation, so your life will become more expensive.
Right.
No matter in almost any scenario. So, and the slope of that curve, I don't know. You don't know. None of us really know. I mean, I don't hope for bad things. I hope we hold together as a country, solve these problems. I hope, we get incredibly productive as a result, as you say, of getting rid of this deregulation and some of the other things that they're doing. Those are all very positive steps. Don't get me wrong. I'm a big fan of all of that. What I'm wondering is back to Lynn's point of nothing stops this train. I look at Doge and I say, well, okay, they want to cut, and Elon's a dreamer, and he's a brilliant entrepreneur. He's taken huge risks. He made them work. But he also tends to be ahead of himself. I mean, he said we'd have full self-driving cars in 2018. You could rent them out as taxis. Well, that didn't exactly happen. And 2018 is now 7 years ago. Yeah. Now, to his credit, though, I rode in a Tesla recently. It's pretty damn close to full self-driving. I was impressed. He said he could eliminate the $2 trillion deficit. And anyone who really carefully looks at it just says not without chopping everything in 50%, because the 80% of it's baked into Social Security, Medicare, defense, and interest. I mean, even if you cut all the rest of it, you still are only cutting about $1 trillion.
Yep.
So there's a real problem. It was sad. What COVID did was, and this goes back to kind of 2008 and even 2000. What starts off as being an emergency measure becomes the new base, and it's almost like a ratchet effect. I mean, government spending pre-COVID was like 4.7. It went to 6.75, and it hasn't come back down. Yeah. And I get it. Okay, it's a crisis. We got to help people. Fine, let's spend a lot of money. But why not, once the crisis is over, let's bring it back to where it was? And that part just doesn't happen, sadly.
Yeah. Yeah. All right. Well, that's a good place to end it. We're going to wrap it up there. Larry, thanks so much for taking the time. The big print, if you want to understand what's going on, don't just take the bullet points we talked about here. Get the book, the big print. We'll link to it in the show notes down below. And if you want to learn how to protect yourself, Larry's got a gold fund. We'll link to that. We also have a Bitcoin fund, Bitcoin Opportunity Fund. We'll link to that down below if you'd like to find out ways to protect yourself.
It's done very well. They had a great year last year, and really, they're dampening some of the volatility in Bitcoin and finding some other great opportunities around it. So it's highly recommended.
Yep. All right, Larry. Thanks so much.
Okay, thank you, Mark. Really enjoyed seeing you.